Welcome to the deep dive. How does a company making these essential ingredients for everyday things like soap and perfume manage to have its best ever financial year?
Right, and not just that, but also get a credit rating upgrade and, position itself as this increasingly critical partner to some real global giants.
That's exactly the puzzle we're tackling today. We're diving deep into Privi's Speciality Chemicals Limited, a big name in the aroma and fragrance world.
Yeah, a really interesting one. And to sort of get to the bottom of it, we've looked at a few key sources you shared.
Exactly. We've got their Q4 and full year FY25 earnings call transcript, their latest investor presentation, and that recent credit rating report from Crisil.
And our mission really is to cut through the, let's say, the jargon and the dense numbers and pull out the really important bits, the insights that help explain what's driving their success and maybe hint at what's next.
Okay, great. So let's unpack this. Maybe start with a quick snapshot.
Yeah.
Who exactly is Privi, and how might they already be, part of your daily routine?
Good place to start. So they've been in this game for over 30 years. They're India's leading manufacturer, supplier, exporter of these specific aroma and fragrance chemicals.
And they're pretty big, right? Scale-wise.
Oh, yeah. 7 manufacturing sites, mostly in Maharashtra, 1 in Gujarat. Capacity-wise, we're talking over 48,000 metric tons per year, and they're actually expanding that right now.
48,000 tons. Wow. And their product range?
It's quite broad. Over 70 products across key areas like pine, citral, musk, specialty chemicals.
Okay, now here's where it clicks for you, the listener. These aren't just like abstract chemical names.
Exactly. They're the actual sense, the building blocks in so many products you use every day, probably without a second thought.
Like what specifically?
Well, think about fine fragrances, perfumes, but also the scent in your candles, air fresheners,
Okay.
the smell of your laundry detergent, your soap, shampoo, creams, even, as one source mentioned, disinfectants and antiseptic liquids.
So it's really about the smells and experiences that fill your home that are on your skin.
Precisely. It's not just a chemical company in isolation. It's deeply connected to everyday sensory experiences.
And they're not just domestic, they operate globally.
Very much so. Presence in over 30 countries. Exports make up, over 70% of their revenue?
Huge.
Yeah, and they're supplying the big guys' names like Givaudan, Firmenich, Symrise, P&G, Henkel are mentioned in the sources.
So they're aiming high.
Definitely. Their stated ambition is aiming to be the #1 global aroma chemical company.
And looking at their recent results, they seem to be, making some serious headway. The sources call Q4 and the full FY25 their best ever performance.
The numbers, they certainly seem to back that claim up. For Q4 FY25, total income hit Rs 628.37 crore.
Which is quite a bit in US dollars or euros. A significant number anyway, up 28% year on year.
Right, but the figure that really jumps out is the EBITDA. That's earnings before interest, taxes, depreciation, amortization, basically operational profit.
How did that look?
It shot up by 50%. 50%. To Rs 147.42 crore in Q4.
Wow. And the margin?
Even more impressive, maybe? The EBITDA margin hit a record 23.46%. That's up over 3.4 percentage points from the year before, and they seem to think they can keep it around that level.
Okay, so profitability really strengthened. What about the bottom line, the net profit?
Profit after tax, PAT, also surged. More than doubled in Q4, actually. Rs 63.98 crore, up 101%. Exports still driving a lot of it, 72.5% of revenue that quarter.
And the full year picture? Similar story.
Very similar. Strong growth overall. Full year revenue reached Rs 2,121.84 crore. That's up 19% from FY24.
And the full year EBITDA?
Rs 474.16 crore, up 35%. The margin for the full year was 22.35%, which is a nice jump from the 19.75% they did in FY24.
So consistent profitability improvement.
Yeah, and apparently, according to the call transcript, they've kept those EBITDA margins above 20% for 8 straight quarters now. That's, pretty solid consistency.
Right, and the full year net profit, the PAT.
Almost doubled there, too. Came in at Rs of 184.75 crore. That's up 94% from the previous year. Exports making up 70% for the whole year.
And this strong performance, it got noticed externally.
It did. Crisil, the rating agency, upgraded them in March 2025.
Okay.
Their report specifically called out the revenue crossing, that Rs 2,000 crore mark for FY25, and the fact that operating margins were holding steady above 20%. Key reasons for the upgrade.
Wow, okay. The credit rating upgrade like that is a pretty strong signal, isn't it?
Definitely a validation.
But hitting these record numbers, especially the margins, What are the sources actually saying drove this? It can't be just one single thing, surely.
No, you're right. It seems to be a mix of factors. Internally, a big piece was process innovation
Okay.
and yield improvements, basically getting more finished product out of the raw materials they start with. This was apparently a key factor for the margin boost, especially in Q4.
So it wasn't just that raw material costs fell across the board, it was internal efficiency.
That's how they frame it. The lower input cost effect is seen less as falling prices and more because of these better yields, plus something quite clever they're doing.
Which,
Developing valuable products from what they call side streams, things that might have been waste before.
developing products from side streams. That sounds interesting. What does that actually involve, and why is it so valuable?
Well, think about a chemical process. You make your main product, but often there are byproducts, secondary stuff.
Right.
Instead of just treating that as waste, maybe even paying to dispose of it, they've figured out ways to purify or transform these side streams into new aroma chemicals they can actually sell.
So turning waste into revenue.
Exactly. It's a really smart way to boost revenue and margins directly from the inputs they're already using. Adds value right from within their own operations.
Very clever. Okay, so internal efficiencies are key. What about the market side? Demand.
Demand seems to have been pretty healthy for their main products. It let them run their plants at high capacity utilization, around 85–90%.
And they're building more capacity too, aren't they?
Yes, actively. They're adding another 6,000 metric tons per year. It's mainly through debottlenecking, improving existing setups, and some augmentation.
Takes a total up to
54,000 tons per year. It's a significant investment, about Rs 250–300 crore in capex. They're funding it with internal money and some debt and expect it finished by March 2026.
So, more volume potential. Are they also bringing out new products? Expanding the range?
Absolutely, that's another lever. They've launched some new ones recently, names like Indomarine, Floravane, Amber Woody Extreme came up.
And what are those used in?
Everyday stuff again. Hair care, personal care, laundry products. Apparently, they've been well received.
And more in the pipeline.
It seems so. The sources mentioned 2 new, quite premium products they're developing, specifically targeting the fine fragrance market.
Moving up the value chain.
Exactly. Expected launch around 2026–27. So it's not just about more quantity, but also higher value.
And what about how they work with their customers? Any changes there?
Yeah, they talk about a shift, moving from just being, a supplier who takes orders,
Right.
to becoming more of a collaborative partner, deeper engagement, working more closely with clients.
Okay. And the supply chain side. That backward integration seemed like a really big point in the sources.
It really is. It seems like a major competitive advantage for them. They've got this strong backward integration, especially around crude sulfate turpentine, CST, and gum turpentine oil, GTO.
Why are those specific materials so important?
Because they're key raw materials for making many aroma chemicals, and they can often be in short supply or have volatile prices.
And Privi has secured a stable supply.
That's the key. They have long-term contracts with over 60 paper mills for CST. This gives them a steady, secure flow of this critical input.
And they process it themselves.
Yes, they can then manufacture crucial intermediates like alpha and beta pine in-house from these raw materials.
So that gives them
Consistent quality, much better cost control, and it really buffers them from the kind of raw material price swings that companies buying on the open market might face. It's a built-in structural advantage.
Yeah, that makes a lot of sense. Control your inputs, control your costs and quality. What about the wider market trends? What's helping them grow?
Well, there's a definite global trend, increased focus on cleanliness, hygiene.
Especially post-COVID.
Right, that got a big boost and it seems to be sticking. That naturally fuels demand for products using fragrances and scents.
And geographically, where's the growth coming from?
The sources point strongly to emerging markets, places like Asia, India itself, Africa, the Middle East.
Any examples?
Yeah, in the call, they mention how in India, for instance, you're seeing more use of things like perfumed soaps, deodorants, even scented floor cleaners. As incomes rise, habits change.
So it's riding that wave of development in those regions.
Exactly. And it's not just geographic growth. Their customer base is broadening, too. They mentioned growing from 3 main key customers to now having 6.
And these are big players.
Yes, includes all the top 10 global fragrance companies now. So they're deepening their reach right at the top.
They also seem to be catching a tailwind from those bigger geopolitical shifts, right?
Right.
The supply chain stuff.
Yes, definitely. Things like China +1, Europe +1, even US +1.
where companies want to diversify their suppliers.
Precisely. Multinationals are actively looking to spread their risk, find reliable suppliers outside of just one region, and companies like Privi, with their track record and integration, are benefiting directly from that.
There was a really interesting quote in the call transcript about that. Something about the supplier becoming more important than the customer's customer.
Yeah, especially the chemical supplier. It's a bold statement, isn't it?
It is. What do you take from that?
I think it highlights just how crucial, reliable supply of these specialized inputs is becoming. For the big consumer goods companies, maybe locking down a high-quality, dependable source like Privi is now seen as incredibly strategic, perhaps even more vital than just focusing downstream on the end consumer, especially with all the recent supply chain shocks.
It really underlines their strategic importance in that whole value chain.
Absolutely.
Okay, another angle mentioned was sustainability. How does that fit in?
It seems to be a genuine focus. They've got a gold rating from EcoVadis aiming for platinum, improve their CDP score for environmental impact.
And does that translate into, like, operational benefits too, or just good PR?
No, it seems practical too. They're using more green power, which cuts energy costs, and they have this Re-Earth initiative specifically trying to make products from renewable resources. So it hits both environmental goals and potentially improves efficiency.
Okay, let's pivot then. We've talked operations, market drivers. What about the financial health itself? Debt, working capital, future outlook.
Sure. Looking at debt, net debt was about Rs 860 crore in FY25, actually down slightly from the year before.
And relative to equity.
The net debt to equity ratio was 0.95 times, also slightly improved.
And the rating agency, Crisil, their view.
Crisil's expected gearing, which is similar, measuring debt leverage to be around 1 to 1.05 times for FY25. Management's own target is to keep it under 1.1x medium term. So debt seems under control, even with the expansion plans.
That's good. What about working capital, managing cash flow?
Also showing improvement. Net working capital days, basically how long cash is tied up in the operational cycle, came down to 118 days in FY25. That's down from 136 days.
And they want to squeeze that further.
Yeah, the aspiration mentioned was shaving off another 15-20 days, although Crisil's view is a bit more cautious there.
How so?
They expect gross current asset days, a slightly broader measure, to stay around 210-215 days medium term, partly because Privi needs to hold decent inventory and typical customer payment terms, debtor days, are around 60-70 days.
Right, so internal goals versus maybe external market realities, setting a floor there. Understandable. With profits up, how do the return metrics look? ROCE, ROE.
Big improvement, as you'd expect. Return on capital employed, ROCE, how well they use all the money invested in the business, jumped to nearly 18% in FY25. That's up from about 12.6% the year before.
Significant jump.
Yeah, and return on equity, ROE, also up nicely from around 10.3% to 16.5%.
And do they have a future target for ROC?
They do. They're aiming for 23-24%.
Ambitious. How do they get there?
Two main ways, according to the discussion. First, getting more sales out of their assets, improving asset turnover. They think they can get from the current 1.4, 1.5 times turnover towards 1.7, 1.8, maybe even 2 times for certain products.
And the second way?
Combining that better asset use with bringing down the working capital cycle, like we just discussed, generate more revenue per asset, get the cash back quicker, it all feeds into a better return on the capital tied up.
Makes sense.
They also noted that the expansion capex they're doing now, the debottlenecking, is actually more efficient for improving asset turnover than building a whole new plant from the ground up.
Right, leveraging what you already have. Okay, and liquidity, cash on hand, ability to meet obligations.
Crisil rates their liquidity as strong.
Okay.
Based on strong expected cash generation, they expect them to make maybe Rs 280, 385 crore a year, while debt repayments are more like Rs 117, 137 crore. Plus, they have decent bank lines, cash reserves, and even potential backup from promoter loans if needed.
So, financially solid footing to support growth. How confident does management sound about that growth continuing?
Pretty confident. They put out a minimum growth target of 20-25%.
That's punchy. What's underpinning that confidence?
They mentioned their order book looks strong, more key clients are giving longer-term commitments now, and they see continued strong growth specifically in regions like Africa and Asia.
What about potential risks, like U.S. tariffs? Did that come up?
It did. They seem relatively unconcerned. Their U.S. exposure is only about 10%, and they feel competitors in other regions often face higher tariffs anyway, so it doesn't necessarily hurt their competitiveness globally.
Okay. And one last strategic piece, the joint venture with Givaudan. Privi.
Right, that's significant. Privi owns 51%. They've just commissioned a dedicated brand new plant for this JV, started in Feb 2025.
And what will it do?
It's set up to produce about 40 specific products exclusively for Givaudan, so it's described as pretty much assured business with one of the biggest players in the world.
What kind of financial impact could that have?
They expect it to break even in the next year or two, FY26 or 27. And longer term, maybe 3-4 years out, it could add RSS 300-350 crore to the top line, growing steadily.
So it's locking in business with a key partner.
Exactly. Seen as a strategic fit, reinforces that collaborative partner idea and provides dedicated service to a market leader.
Okay, so pulling all these threads together, the record financials, the efficiency gains, the smart strategies like backward integration and side streams, the market tailwinds. Why should you, the listener, care about this deep dive into Privi?
Well, because looking closely at a company like this, it really opens a window onto some much bigger economic and industry shifts happening right now.
Yeah, you can see the impact of that growing global middle class wanting more consumer goods, right?
Definitely. And the heightened focus everywhere on hygiene and personal care, which needs these kinds of ingredients.
Plus those big supply chain realignments, the whole China plus one idea in action.
Exactly. And also the increasing pressure for sustainability in manufacturing, even in basic chemical industries. Privi's story touches all of these.
So by understanding Privi, you get a real sense of how these essential, often invisible parts of everyday products get made.
Right. And you see the kind of competitive advantages companies build, that deep backward integration, the strategic JVs, and you see how these big global trends directly shape the fortunes and strategies of industries that ultimately create the products you interact with constantly.
So wrapping up then, this deep dive into the sources really shows Privi Specialty Chemicals hitting a strong stride. Record performance fueled by that potent mix. Better internal processes, smart expansion, new products, a really robust supply chain edge from backward integration.
And catching favorable global wins, like those supply chain shifts and growth in key emerging markets.
Okay, so here's a final thought to leave you with, building on all this. Privi wants to be a top global player. They're clearly focused on both scale, getting more capacity online, and adding value through new premium products, better yields, using those side streams.
Given that dual focus, and especially considering their strengths in backward integration and deepening those client partnerships, how might their continued growth and evolution start to reshape the whole global aroma chemical landscape? And maybe more personally, how might that change the very sense and sensory experiences that make up your daily life?